Hi, this is Morgan Smith, financial advisor, partner, and your host for the 10 Myths of Investing video series here with my special guest, Vice President at Dimensional Fund Advisors and the Secretary of Explaining, Apollo Lupesco. How are you doing today, Apollo?
Hey, Morgan, good to see you. I'm doing great.
Good to see you. Well, today's topic is the number one myth. The first myth we're going to look at is successful investors need to time the market. So the premise here is if you're going to be successful, you got to time the market. My perspective is, and what I tell my clients is, look at sometimes you can time the market and get lucky, but remember one factor is the market is a two-headed dragon. You got to time it going in and time it getting out. And another thing is, it's like when you talk about the market, which you start, if when you start digging down, there's a whole bunch of different parts of the market you might need to time. So there's the global market. Are you going to time the global market, or are you going to the each country? Because each country is going to have their different cycles, and then you dig that down to sectors. Each sector has within a country has different, um, I guess, cycles, and then you could dig down even further to specific stocks. So the number one myth: successful investors need to time the market. Apollo, is this truth or myth? Uh,
Yeah.
what say
It's
you?
absolutely a myth. It's absolutely a myth, in my opinion, because, you pointed out like one of the big things out there that is hugely important. I mean, several of them, in fact. The first one is that, if you wanted to time the market, which basically means you need to know when to be invested and when to be on the sidelines. And I think this is something that we have been kind of pitched by the media and by companies who kind of define this as successful investing. Well, obviously, you don't want to be there when the market drops. And you just want to be invested at the right time. And this idea is intuitively appealing. I'm not going to tell you it's not. In reality, it's really not possible to implement. And Morgan touched on a couple of reasons why. One, because you need to know when to get in, but also when to get out. And being able to make two correct decisions at the same time is incredibly unlikely. And also, we don't know anybody who can consistently make those two correct decisions. And then also, what exactly is the market? Is it what you see on the news, or something that is broader in nature? What I'm going to start, just to kind of demystify that a little bit, is to really look at the history of the markets, and really tell you folks that the markets going up or down, it is part of the fabric and the nature of investing in an equity ownership. Because when you buy stocks, you basically buy ownership into a company, and the value of the ownership, it really depends on what is that company expected to make in earnings and profits. Because as a part owner, you are entitled to part of those earnings. And over time, we know that profits fluctuate, and so does the stock market. So the first thing to know is that the nature of the stock market is to fluctuate in value. And in fact, if you look over the long run, and we have data going back to the 1920s, what you see is that the S&P 500, which is a broad measure of the US market, is basically a sequence of bear markets and bull markets. Bear markets means that it drops by about 20%, and then bull markets, it goes up. And obviously, when you look at this, just visually, when you look at this, just the history of the markets, what you see are two things. First of all, is that bear markets happen. There's certainly a lot of bear markets that we've seen across time. So it's not really unprecedented or unusual to see a bear market. At the same time, you also see visually that the bear markets tend to last not nearly as long as the bull markets. And you have a lot longer bull periods than you have bear periods. So that's the first good news for investors, is even as the market drops, you don't necessarily need to know exactly when, because what you see is that periods of bear markets are followed by bull markets. But the second interesting thing that I see here, Morgan, is that these bear markets do not come in predictable patterns. In other words, I can't tell you that when the next bear market might come. I know it will come. It's just not possible to know when. And really, the analogy that always kind of resonated with me is that here where we live in Southern California, at some point we know there will be an earthquake. I'm under no illusion that I'm going to live my whole life without seeing an earthquake, a bigger one, a smaller one. The same way that I know the market's going to drop, but that knowledge is not sufficient. I also need to know when. And the same way that one cannot predict an earthquake, it's a foolish errand to try to predict when the markets are going down. So the first reason that I will tell you, folks, is that we know the nature of the market is to fluctuate. We just don't know exactly when that fluctuation will happen, when that bear market will happen. Beyond understanding the nature of the stock market, as we talked about the bear and bull markets, what is also really important is that you look at data and evidence. And we suggested that when you look at the markets, they're unpredictable. But the big thing that it's so huge is to really understand that the nature of the stock market and what you experience, to a good degree, depends also on the time horizon on which you look at. So when you're trying to say I'm timing the market and you want to have a positive outcome, there's some really interesting statistics that one can look at. If you examine the S&P 500 and you go to finance.yahoo.com, you look at the daily market returns in the S&P 500. Again, this is on a daily basis. What you see is that roughly 53% of all trading days in the market are positive, and 47% of the time they are negative. Meaning that if you're going to watch the market, if you're going to try to look and figure out what the market's going to do on a daily basis, it's it's almost like a flip of a coin. You have a little bit better chances of seeing a good day, but most often what you see is that it's a pretty rough split. So you have a little bit better odds, but not tremendous. So trying to look at the market on a daily basis, please be aware that you are likely to be disappointed roughly half the time. Now, most investors realize that looking at the market daily, it's not the most productive thing. So when you now look at the markets over a more extended period, which is still short term, but instead of daily, you now look at monthly. What you see is that on a monthly basis, roughly about 63% of the time the markets go up, and 37% of the time it goes down. And what happens from month to month? It's quite random. So in other words, what happened last month in the market doesn't really have a bearing on what's going to happen this month. But what's fascinating is that there's the idea that I need to know when to get in and out, when to get out of the market. And if you do get out of the market, it's possible that you miss a bad month and you kind of pat yourself on the back and say, great, I saved myself some money by not losing it. But here's the thing, though. If you look at this statistic, what is it more likely for you to miss if you get out of the market? A good month or a bad month? And it's quite obvious that you're a lot more likely to miss a good month. And because of that, exiting the market thinking that I know, I think it's going to go down, it actually puts the odds against you because you're a lot more likely to miss a good month rather than a bad month. And lastly, the more you extend, so now you go to a whole year, and on an annual basis, what you see is that roughly about 3 and 4 years, the market, the S&P has gone up, and only 1 and 4 has gone down. So the longer you stay out of the market, the more likely is it that you will see a positive outcome over any given year. So to me, this idea of getting in and out of the market timing, constituting successful, it's not really the case because ultimately, of the reasons that Morgan suggested, is that the first one is that you need to make 2 correct decisions at the same time and also define what the market is. The second reason is that you do have the data against you, that you're a lot more likely to miss a positive month than a negative month. And the last thing that I'll tell you that I don't think it's quite possible is that markets are driven by events, what's going on in the world. And those events are unforeseen by definition. And one of the big things, Morgan, was that if you look at December of 2019, and let's say that you had a fairy godmother who told you, listen, we'll go through a global pandemic in 2020. We'll all be stuck at home. The global economy will be put on hold. What would you have done with your money? Most people would say, well, if I knew on December 31st, 2019, that's the case, I would have yanked my money out of the market because obviously they cannot be good for the market. And what's fascinating is that by the end of 2020, the year of the pandemic, the S&P 500 was up 18%. So even if you were to know exactly what would happen in the world, that doesn't mean that you would make the correct decision with your investments. And because of all these reasons, we don't think that moving in and out of the market, which is what market timing basically means, is the optimal strategy for an investor.
Well, that's great perspective. And I think when we talk about investing, and you were talking about some statistics, we want the odds on our favor. Really, when I think about it, when I'm speaking with clients, we want to give them a higher probability of a successful outcome. And that's kind of what you're talking about there as well. I will also say that uh, the you can get lucky sometimes. But what really kind of resonated with me was the unforeseen variables. And I think that instance that you brought up in 2019, I mean, everyone I was, even me, I was feeling doom and gloom,
Right.
stay indoors, don't go anywhere. And there were just opportunities that were created even by a significantly negative impact. And it was amazing to see how the market recovered after that. Well, great, Apollo. That wraps up our first video. Myth number one: successful investors need to time the market. Well, I think we've debunked that myth. And Apollo, I very much appreciate your time. And I'll see you next time for our next video, myth number two.